The last comment I'd make is that Paul on the last panel, who runs a $6.5 billion multi-single family office, mentioned that sometimes he'll track somebody for 4 to 6 years before investing. I know that can, I guess if we can quiet down the room a little bit. In the middle here, if we can keep the talking down, that would be great. But I know that 4 to 6 years can sound like a depressingly long time for some of you, trying to build real relationships. But sometimes it's just 4 to 9 months. But if you go into it with a mindset that all that matters is who you can close in the next 60 days, then things are going to backfire, and it's not going to go well in the family office space. It's not about making a quick dollar this month. It's about finding a couple strategic investors who can really support you over time. All right, with that, would like to get started on the next discussion panel here. And this panel is going to be talking about what is working in the marketplace. What is working to help people raise capital from family offices, from private investors in general, maybe from angel investors and small institutional investors. A lot of individuals struggle to raise their first $5, $10, $20 million, while others are raising $30 million, $100 million, or $200 million a year. We have some individuals here in the room that are growing by $1 billion a year in AUM. I know we have a few groups here that raised over $250 million of equity last year for their real estate projects. And then we have others here who have never raised a dollar, and they just started their own firm. So the point of this discussion panel is really hear from successful sponsors, those who have done very well, learn what they're doing to navigate the family office space, and learn from peers who are every day meeting with family offices and working with them as clients. And to start out, I just want to go down the line just for 1 or 2 minutes, maybe share each of your perspectives. Maybe David, starting with yourself, and introduce yourself to the room, please.
Yeah, sure. I spoke here recently, I think 45 minutes ago. But yeah, David Babinski with True North. We've got a enterprise of companies with the main focus on tax savings, and then that leads to several branches that are specific to the capital raising side, the educational side. We deal directly with individuals, and we also deal between now and April is the perfect time. And I'm sure we'll get into it.
Great. Thank you, David.
Thanks. So I'm John Santema. I'm a co-founder and a general partner at Regal Healthcare Capital Partners. We're here because we are Fund 1. We raised our fund about 18 months ago, $90 million fund. The focus of the fund is investing in businesses that can benefit from the consumerization of healthcare. So our focus really is on provider businesses, retail-based healthcare businesses. My personal background is I was a healthcare investment banker for 20 years, most of that time at Citigroup and at UBS, and ultimately I was the global head of healthcare investment banking at Jefferies. My personal client base over those years really were healthcare services companies across the spectrum of healthcare services. My partner is probably known to some of you, Dr. Dave Kim. Dave founded what ultimately became CityMD, and that's kind of the poster child for our investment thesis. CityMD, as you guys probably know, is the leading urgent care company here in the tri-state market and growing very, very quickly. So Dave was an emergency room physician, actually an operational engineer by training. Decided to go to medical school, became an ER doctor, found himself in an emergency room in the Bronx, and realized it was probably the least efficient place to deliver health care, and pretty quickly put up a shingle and started what was really one of the first urgent care offices in the New York market. Ultimately, that became CityMD. He helped grow CityMD to 80 offices and sold it in a very successful exit to Warburg Pincus about 2 years ago, and that really triggered the fund. A number of Dave's doctor partners who had invested, obviously, in the CityMD business, but also a few other businesses Dave had developed and started from scratch, said, look, we got this money from Warburg Pincus. We want you to keep doing great things with it, Dave. We want to keep investing. So they gave him a chunk of that money, and Dave said to me, John, do you have any interest in trying something new? And it sounded pretty interesting, so we partnered up. I called some of my longtime clients, healthcare executives, well-known healthcare entrepreneurs, a number of whom had family offices, and they ended up investing about a third of the fund. Dave's partners were about a third of the fund, and Dave and I are about a third of the fund. So we were up and running in about 6 weeks, which was a little bit of a whirlwind. but fun, and we've been around now for just under 2 years. We've invested in autism services, dermatology, retail dental services, fertility, and medical billing. So it's been a busy period. We focus on lower middle market. We focus on businesses with 3 to 5 million of EBITDA. Proven healthcare delivery businesses that have a couple of locations and want to grow like CityMD did to, from 2 or 3 to 30, 40, 50, 80, and become regional leaders.
Great. Thank you. Nate?
Hi, I'm Nate Klein, one of the principals and founding partners of One Wall Partners. We focus on workforce housing, primarily in the Northeast. We started buying assets in Essex County, New Jersey in 2013. Raised most of our capital from high net worth individuals and family offices. We've just got our first institutional partner on a preferred deal on a big transaction we're closing in a few weeks. My background prior to the real estate is that I spent time at Merrill Lynch doing M&A, Fortress, private equity, and then traveling around the world teaching finance and doing consulting on private equity and M&A transactions.
Great. Thank you. Mark?
Hi, Mark Nazzarini. In 2008, I was in commercial construction, had a successful business. We won about $50 million in bids in Cleveland, Ohio. The economy changed. In 2010, we won zero. So I was looking for something to do. My brother-in-law went to University of Kentucky and is a geologist. Introduced me to his old college roommate, who was a fourth-generation oil and gas man in eastern Kentucky. So in 2011, I started Drill Baby Drill. Raised capital exclusively for that sponsor. So having come from a great business, I thought, well, the first thing I had to do is raise $1 million. Why not? So first year, I didn't raise anything, kind of reevaluated. My first deal was $105,000. I thought that'd be a little easier. I was successful. I ended up divided that into 16 parts, which is 65, 62, 50. I sold 8 of those, and I funded the other half to get my first deal on the ground. The next deal was $400,000, was pretty successful. And then where the business really took off was $750,000, and within 12 months, that deal returned $3 million. My network started to grow. The next deal was $5.8 million. And then I had a network, maintained some of the smaller ones. And then eventually joint ventured with my sponsor. I earned his respect at that point and shared his network. And the last deal we did was for $30 million. So I really raised capital exclusively for that one sponsor because he's consistent, reliable, under-promise, over-delivers. In the last 4 years, we've had 3 exits that returned 2x to 4x to investors, very consistent. And so I joined Family Office Club about 6 months ago. I had been successful just raising capital within my own network in Northeast Ohio, and I came here to just meet new people, expand the network, and it's worked out pretty well so far.
Great, thank you. And so we had a question on the last panel that we didn't have time to address very much with the last panelist, which was, how do you identify the families who actually want what you're looking to provide? Like, for example, with you, Mark, oil and gas. How do you know what families want to even be looking at oil and gas deals or healthcare deals? One or two of you want to take a swing at answering that on what you do to make effective use of your time and know who to go to?
Well, for me, it was pretty easy. I looked at my client list. After 20 years, I had a few relationships. And it goes to a lot of the themes that you hear today, which is it's all about knowing people and building trust and relationships and long time knowledge and experience with people that invest with you. So, everybody in our fund knows healthcare. They're all healthcare experts. Dave and I were viewed as having good subject matter expertise. And I think between the long-term trusting relationships we had with these healthcare family offices, healthcare entrepreneurs, and their trust that we would make good use of their money. That's really what led to the success. So now we're getting inbound calls from, as the word's getting out, a little bit about what we're doing. And, we're not actively raising money now, but we are, for reasonable people that are reaching out, we're taking meetings and trying to build relationships for the future.
Sure. I think you mentioned a couple of really important things. One is you had relationships with people for a long period of time. You had domain expertise that others recognized around you. And three is that you're going to healthcare professionals who already understand the diabetes center, they already understand the urgent care center, et cetera, right? Those seem like three critical things, and a lot of times people are missing all three of those, or one or two of them at least, I find. Mark?
I was going to say, one of the ways I found to expand my network and find people who are interested is once the deal closes and it's funded, that's really just the beginning. I spend a lot of time communicating, getting to know my investors from beginning to end. And as I build up that rapport relationship, find out how often they want to be updated, whether it's face-to-face or email. I like to try to do face-to-face at least quarterly and keep them well informed. And as that relationship develops, their network seems to open up and they're more willing to introduce you to people who might be interested.
Sure. David?
Yeah, our experience with that is, we're somewhat on the cutting edge. A lot of our plans might be red flags for your day in and day out CPA, but we attack that head on. Where we excel is education. So we don't want to slide something by your current advisor. Who do we need? Who else needs to know about this? So we had a Disney executive come in, and the first thing we said is we want to meet with your family office and educate them. Had a good relationship struck with the CPA. He understood it. He understood our safeguards and how our program worked. And then he turned around and introduced us to 3 other families that wanted to have the benefits and didn't even realize that with such short notice they could get a 2018 benefit. So it's not running away from all their other advisors. Being, in your niche, be, knowledgeable in what you're doing, and don't be afraid to educate. And the business just comes from their network, and we expand on that from there.
Great. Yeah, I think it's a good point that you can educate to attract people who you didn't even know were interested in healthcare or oil and gas or conservation easements, but then also after you engage with them, educating them to de-risk and build trust and add to their conviction on moving forward, I think is just as important. But at the center of all investments is about trust, growing the trust, and a lot of that comes through education. I found that's why we bring it up so often. One of my first questions for this panel today is, what do you think makes up an investor relations advantage for your firm? What's allowed you to raise capital while others struggle to raise capital? If you could narrow it down to just one or two things, and hopefully we're not repetitive as we go down the line. Maybe we could start with you, Mark, and just work our way down towards this way.
Well, like I said, one of the main way is making sure that the investor has a good experience from the moment they invest till the close. That's really where the work begins. Get to know them and establish relationships, and that really is how I've built my business.
Sure. Great.
Yeah, one of our core values as a company is delivering on the promise, and I think that's particularly important and evident as it relates to this question and conversation. We're definitely of the mindset of under-promising and over-delivering and being conservative and underwriting and giving people full transparency on all investments and how we made our decisions and what we're looking at and how we're analyzing them. And then the second thing is really being a two-way street in terms of conversations with investors and prospective clients and so on, is that listening to what people have to say, their feedback, responding to it, acting on it, not just kind of taking it as a criticism and moving on. We really try to involve everybody and their opinions.
Great. Yeah, and I think what you said is so important about under-promising and over-delivering, because I think that experienced investors, when they see that somebody's promising a massive return, then they're feeling like that manager is not really respecting the fact that they should be over-delivering if they're promising the world to the investor. And also at the same time, if you're a consumer products company or a company doing a capital raise and you're valuing yourself at 15 times revenue, because that's what companies exit at in your space, but you're doing under $1 million profits and everyone who's exiting is doing 10 million plus EBITDA, you're giving yourself the valuation of what you might have a decade from now. And again, you're asking the investor then to overpay, and it's very hard to over-deliver when you're pricing things at what you might do far down the road, I find. It's just kind of disrespectful to the investor. So as soon as they see stuff like that, they just back away, turn off, archive the email I found. So I think that's really important, what you brought up there. John?
Yeah, I think in our case, our advantage was I think really threefold. I mentioned I think people perceived our expertise as being attractive, my transactional experience over 20 years, and Dave's operational and entrepreneurial success. I think having Dave, Dr. Kim in the mix was important because we didn't have a track record. Dave had started, in addition to what became CityMD, 2 other businesses that had realized extremely high multiples of invested capital. One was in the retail dental sector, another one was emergency room management. So we discussed those deals with investors. Again, they didn't have institutional money. That was all Dave and his doctor partners, but they were good successes. So I think that having that track record to speak to was valuable. And I think another very important thing that put us over the goal line was a very outsized GP commitment. And I think investors felt very aligned with us. As a matter of fact, given our commitment, Dave and I kind of call this a friends and family office with the way we're structured.
Sure. Great. David?
Yeah, so I would say the key for us is similar to what I said before, but add value first. You know, there's really 2 parts to it. You need to add value first. So when we're coming into a new relationship with someone, we will go move mountains to show them, you know, what kind of benefits we can offer. But the other thing is, and I know that Richard says this all the time, like, no one else can do your push-ups, right? Like, this is hard work. Like, you have to actually engage with people. You have to talk. You have to get into and listen. See, that's the key instead of just presenting. So how we add value is we listen, and we basically can customize our offerings to each individual person. I'll give you an example. We are a CE provider for the American Dental Association. And again, you know, we'll talk to an individual dentist, but we want to know who is the preeminent CPA for dentists in Indianapolis. And then we'll go develop a relationship with that person. So again, you know, it's interesting how you say, you know, you started with 100,000 and you only got halfway there, right? You had to put your time in. It doesn't just happen overnight. There is no magic email that's going to get, you know, oh, send me your wire instructions. That's never going to happen. Oh, thank you for sending me that attachment of 80 pages. What are your wire instructions? So if that starts to happen, we should all leave this profession because it's just never going to happen. I don't care what kind of crowd wants to fund whatever. You have to do the work, and the only way to do the work is to add value.
Those are really good points. I sometimes have people come here in the Family Office Club. They've never raised capital for anything before, but they want to acquire a professional sports team for $2 billion, or they're trying to get a real estate deal done for $4 billion. And you know there is no chance in the world probably that they're going to do that unless they just piggyback on some big brother firm that has the team, the experience, the track record, the trust of the market, et cetera. It's just not going to happen. So I think that many times, even when someone's looking to do a $200 million fund, if they haven't done a fund before, it might take them 2 years or 3 years to raise $200 million, or they might never get it done, versus if they just raised a $3 or $5 million fund or a $15, $20 million fund, got that done, did fund 2 the next year, did fund 3 the next year, they can maybe raise that $200 million across 4 funds. Now they can say, we're on fund number 4, because family offices will say, you know, nice to meet you, but, you know, show us your next one, show us your next one. We want to get to know you, want to get to know your team. And it shows momentum versus living a life of frustration and investor exhaustion, thinking that maybe you can't pull it all together. I guess that's what you've done.
Yeah, and you mentioned listening as well. One of the other keys that I've found is, you know, don't be afraid in an investor presentation if you're listening and you come to the conclusion that maybe this isn't the right opportunity for them, and to say, you know, this isn't lining up with your investment goals. Let's talk a little bit more about it. When I have something that's a better fit, maybe I'll come back. And you earn the trust and the respect of the investor that way, and I think that goes a long way.
Sure. Also, out of 400 people here, you know, just having the name Drill Baby Drill has a little bit of a sense of humor, which never happens in our industry. So I think that's always appreciated. If you're naturally, you know, if your strengths are getting along with people, or you do have a sense of humor, I think like it makes a little bit of a difference, because almost nobody does in our space. Everyone's straight-laced and conservative and just pitching, and kind of lacks personality sometimes. So I also want to point out what David mentioned about doing your own push-ups. I recorded a video of that on YouTube, and it's gotten a lot of views about how A lot of people are trying to find the magic bullet to raise capital. So they think that if they found the one placement agent or they found the one person that can make introductions, and many times people think that, well, we have over 1,750 registered family offices in the Family Office Club. Richard just introduced me to the 20 who want self-storage right now, and I'll get my whole fundraise. But I'm not waving the self-storage flag. I'm not only meeting with self-storage interested parties. I'm not a domain expert on that. People don't call me asking for self-storage guidance. You have to do your own push-ups on that because that's your expertise. That's your unique game that you're playing, and nobody else can do that for you. No third party is going to do that hard work for you. Just like we heard John's experience in healthcare is what's led to the trust and the network and the years of relationship building, et cetera. So I think that's at the core of all this and really critical to success in raising capital. I do want to go down the line in case somebody has deal flow that would link up with somebody here. We've had joint venture deals, new investment firms get started, $50 million seed allocations get done, fund managers get allocations, et cetera, from talks here on stage. So I'd just like to go through, starting with you, David, on as specific as possible, what's the most valuable type of deal flow or connection that you could make here today, and then we can just go down the line.
I think where, again, I could add the most value is if somebody is working with professionals, somebody's working, on an investment, assets under management, and you don't have the tax strategy expertise, you don't have the retirement plan, you kind of ignore it and hope that they work it out. Give you a quick example. We spoke in Key Biscayne, and Richard was nice enough to ask us onto one of his podcasts. So we called in and did the podcast. Lo and behold, a week or two later, I get an email through the website who said, I work with a bunch of physicians, they're W-2. I never knew that you could get, after everything, you could take a deduction and save this amount of taxes. Can we meet? And he flew to Orlando, and we ended up having dinner last night. He happened to be in town. And in the last 4 or 5 days, I've gotten 24, 30 referrals from him. So it took a year. We developed the relationship. We met in person twice, and the floodgates just kind of opened. So, somebody who wants to add to their offering, I don't want to call it a private label or a white label, but that's the type of network we're building. We've filled 9 deals last year, basically through 2 multifamily office relationships. And
Great.
if we added a third in the next 3 years, that'd be a bonanza for us. So it's not like we don't need, a little from everybody. We're just looking for the right relationship.
Great. Yeah, no, that's a good point. We've got probably 12,000 downloads a month of the Family Office podcast, and we're putting out 2 episodes a week. Sometimes we put out a 3rd episode. So appreciate any of you that are listening to that already. John, what are you looking for as specifically as possible?
Yeah, so it's an interesting background, actually, because I built my career and reputation as an M&A advisor selling larger, attractive healthcare services business to middle market and big cap private equity funds for 15 times EBITDA, which was great for my clients. But when I decided that I wanted to start investing my own and put a big chunk of my own net worth into this, it didn't feel great, like going somewhere to spend my money at 15 times EBITDA. So that's why we actually developed our thesis, which was to go down market, which was to find smaller companies with 3 to 5 million of EBITDA that have a couple of locations, that have a good model, and that we, in particular with my partners, experience around building from scratch, leading regional leaders to help that firm or that doctor practice or the optical business or whatever go from 3 sites to 30 or 40, 50 sites. And then you can do that at a much lower multiple, and then hopefully on the back end you got out at the higher multiples. So as I mentioned, we've done business investments across the various sectors. We're continuing to look at additional deals. Again, things that mostly really have a retail-type franchise, so veterinarian services, outpatient physical therapy, ophthalmology and optical, behavioral health, even addiction, other areas that are in the news that need a lot of help. So we really feel we can invest in these companies at good valuations, bring the expertise to help them build infrastructure and get ready to scale up, exit it, get a nice return, and at the same time really help a lot of people across these healthcare verticals.
So are you trying to acquire now at 3 to 5 and usually comes in 6 to 8 on the multiples? Or
So anything of any size in healthcare services is typically selling 10 to 12, 11 to 13 times EBITDA. Size meaning sort of 20 million of EBITDA or more. Sometimes even smaller gets to that multiple. So we're typically investing in high single-digit kind of multiples, 6, 7, sometimes 8. And then if we're doing an acquisition strategy, you can usually acquire a bolt-on office in these various subsectors at more like 5 times, and then you improve them and you get down to 4 times, and then hopefully you'll get the double-digit exit on the way out.
Sure, sure. I know we've had a couple dental clinics come into the Family Office Club recently, so we should chat. Nate,
Anybody here who lives in New York, Dental 365 is one of our investments, and Dave started it. It's my dentist on West 79th Street. They're great. Go see.
Nate?
Sure. So, as I mentioned before, we focus on workforce housing. The way that we define that is market rate apartments that are affordable to people making 60 to 120% of the local AMI. We primarily target trans-oriented and lifestyle-oriented properties that are in walkable areas, access to retail, employment centers. Typically that means an urban location or an infill location. We buy, generally speaking, undermanaged assets from smaller or non-institutional operators, improve them, fix them up, renovate. We buy well below replacement cost. We have a lot of upside in rents because of either rental discrepancies between other neighborhoods, nearby towns, or household ownership costs. There's significant variation, for example, between the affordability of an apartment in Newark, New Jersey versus a home in Westfield, New Jersey. And you draw the same kind of base of people from an employment center access standpoint when you look at two places like that. So I mentioned we're big owners in Essex County. We've also making a big push into some of the outlying neighborhoods in Philadelphia, northern and western suburbs predominantly. We have 2 primary investor buckets. One is sort of a preferred income. It's a very secure, relatively high returning, large co-invest from the sponsorship side. Oftentimes we do that in a recapitalization format where we have turned around a property, stabilized it, now we're selling down equity, retaining a big stake, let's say 40 to 50%, but the cash flows of the refinanced asset support a very nice preferred return for somebody at a very low risk. And then we look a lot for JV partners to do some of the larger deals. Typical purchase prices are anywhere from 10 to 100 million plus. So there's a lot of different check sizes that fit within our deals, and we find a lot of opportunities in these sort of what I call sub-institutional space. There's less competition. We've been able to bid on things where there's only a handful of people involved, but really getting nice assets or short-circuiting processes or finding things off market. One of the best kind of risk-adjusted returns I'm seeing in the market right now for the things that we look at are some recent vintage Class A stuff that maybe was institutionally owned at one point, but it's reached its investment timeline, and now they've got to roll out of it, and it's a little bit too small for another institution to buy it, but at the time it was something that was attractive. We just bought 164 units from Matt Calley at a price that was several $1 million below what they paid 5 years ago for the same asset.
So Nate, if I toss this microphone, I could probably hit a couple multifamily sponsors here. And if one out of the 2 of them is probably struggling to raise capital, do you think that there's so many multifamily independent sponsors that is the challenge? And part of the question is, what's allowed you to raise capital? Because some of the sponsors out there are trying to figure it out, and they haven't been able to crack it. So what's been making the difference? Because there is a lot of groups out there doing what you guys do.
Yeah, there are, and it's hard to distinguish amongst a lot of groups. And
Sure.
I think what's lacking for a lot of folks out in the marketplace is a fine-tuned rifle approach to their strategy. I think people look at too many different markets at the same time, or too many varieties of different properties. We're very kind of laser focused on this specific niche and attacking markets and having boots on the ground in the locations where we operate. And we have domain expertise in those places and long-standing relationships, et cetera. And so if, I'm not going to all of a sudden bring a deal to somebody in this room where I say there's a great yield on this random property in Iowa because it doesn't fit our strategy.
Right,
So
right.
everything that we're doing is going to be on brand or on message to what
Yeah.
we've presented.
I think that's so important. The more competitive your space, the more laser-focused you have to be. The more small and new and undercapitalized of a firm, the more laser-focused you have to be. The more that you haven't gotten traction yet, the more that you're going to learn and get quick market feedback. If all you're doing is acquiring diabetes centers, and that's all you do, you're going to know that market real well and know whether there's good investments out there or not, and people know what deal flow to send you because of that laser focus. So I think that's a really important point for those of you that are getting started in raising capital here. And then finally with Mark, what about yourself in terms of the exact types of oil and gas or wells you're looking to drill, et cetera?
Specifically right now, we've been in mineral rights in the state of Kentucky. And interesting, in the state of Kentucky, mineral rights are severed from the surface, the land rights, deeded and recorded separately in the county courthouse. And they're classified by the IRS as real property. So you can 1031 exchange in, and actually when you exit, you can 1031 exchange into any other real property. Anybody with looking for 1031 exchange money, I've had a lot of success there. But specifically, I have two types of deals, which are more of a return on capital with cash flow versus long-term growth. So in the 1 million and under range, 10 to 20% cash on cash return with some growth secured by the real property, and it's 1031 exchange eligible. And then also in the mineral rights, the $5 to $50 million range, we have about 40,000 acres available. Short-term, 2 to 4x return. I'd say that's in a 2 to 3 year window. Long-term legacy as a hold. It's an emerging play. We have proven there's been $80 million worth of exploration. We've had petroleum engineers. We've got a proven play that's, we know that it's in the ground. They've compared it to Wolfcamp in Utica. We're buying at $1,000 an acre. The P's are valuing the oil and gas in the ground at $33,000 an acre. Now, in the under promise, over deliver, we're not saying we're going to sell it for that. That's probably a 20 to 30 year number, and discounted for time and development. So that's where we come to and we've been doing this for quite a while with successes. And when things take off, and they're starting to, I'm looking in a 3 to 5 year window, 2 to 4x return. So cash flow for cash on cash return, I have million and under, and anybody 5 to 50 million for long-term hold or 3 to 5 year growth.
Great, thank you. And I'm familiar with Mark's model because about 2-3 months ago, he had submitted through the member portal the capital raising audit, the review of his materials. We just gave him some feedback, and it allows me to get to know some of the Family Office Club members a lot better than just coming up and shaking hands for 2 minutes when there's so many people in the room. We're doing 45 reviews of materials for members this month, and we do it on the 15th of each month. You get your feedback 10 days later, and you get a 3 to 5 page analysis of just things to consider changing on your branding, your positioning, your wording, your pitch deck, your website, your one-pager, etc. And you may not want to take any of the advice, but there's almost always ideas in there that once you read it, you say, oh, yeah, that's something we probably should get in place over time or consider. Any questions from the audience real quick? We have time for 1 or 2 quick questions. These are all individuals that have figured out how to raise capital from family offices, work with private investors, attract them consistently. Yes?
Hey guys, thanks for speaking with us. My question is a little more about the psychology of kind of persevering before you start building momentum. And we kind of talked about how long it takes to start building those relationships before capital is deployed in support of what you're doing. So what advice do you have for newer emerging managers such as myself who are, how do you kind of work your way through the initial no's to get to a place where you ultimately start hearing yeses and getting that momentum? How do you kind of stick with it and persevere?
So the question is about timeline and psychology for early stage emerging managers, new sponsors. How long do you stick with it? How long should you expect it to take before you see signs of hope and getting capital raised? So you're not sticking to it too long, but also not giving up way too early. Does anyone want to comment on that?
I'll take a stab there. What came to mind was it's hard to climb Mount Everest without a Sherpa, right? You almost need a mentor, or you need to identify 5, 6, 7, what I would call most wanted. There's a famous quote, and the name isn't coming to me, but they said, every time I went to someone and asked for money, I got advice. And every time I went and asked for advice, they ended up giving me money. So I think it just depends on, like you said, the psychology behind what are you trying to get. So maybe those first 5 or 10 that you want to invest in, you actually approach and say, hey, I need some advice. This is where I'm trying to get to. And that relationship building will lead to money that's coming in. That's a long game. You have to be patient. I don't know any other way to answer that, though.
Sure. One thing I'd mention related to that is that we've found that there's a lot of placement agents out there who will help raise capital. It's very hard to get them to help when you're at a very early stage. But we found that there's a big gap of not having any training or practical examples on how to get progress and get it done. And what we're trying to do, instead of someone coming to us and saying, hey, can you give me 10 leads for people that want to invest in stem cells, instead of giving them those 10 leads, or you could call them fish, and they say, hey, I need 10 fish. Instead of giving them fish, we say, here's how to build a net, here's how to sharpen your hook, here's the bait, here's how to add genuine value so that the fish are coming towards you and you're positioning yourself right. That's our attempt to try to be as helpful as possible. We have time for one more question, if somebody has one. Otherwise, then we'll give our panelists a chance. Did anyone here want to get across a really important point that hasn't already been said that's really critical for those in the room to hear? Because I know we only went through about half the questions that we could have, because we asked a couple extra ones.
The one point I wanted to make, I guess, is that what I learned from my experience, and kind of answers your question a little bit, is you're much better off with a smaller, successful project. Will do more for growing your business than spending a bunch of time just trying to have that larger project. I mean, I think I learned that early, but really taking off small pieces and growing slowly over time. As you grow, your skill and your network start to match the dollar amount as it grows. So it's to start out small.
I think one comment I'd make, especially to kind of the timeline for getting going and getting the first thing up and running, is that what I found was that family offices are really different. You can't take a one-stop shop kind of approach to all the family offices. In particular, I found the biggest difference, and this was when I was a banker as well, and we had certain deals that might be attracted to family offices, that a $50 or $100 million family office, typically the wealthy individual who's behind that office is still pretty active, and they really look at something and decide if they want to do it or not. I found when we got to bigger family offices, 500, billion kind of family offices, it was very institutional. They had a team that was in there that was screening everything, that were asking institutional-like questions and getting and in terms of data requests and all that information. And so I think if for an emerging player, it's probably easier. For an emerging manager, it's probably easier to be focusing on the smaller family offices where you can get the ear of the founder and hopefully get them on board. I think it's easier than working through what they've set up in the bigger offices to basically keep you from talking to the founder.
Great. Thank you. David?
Yeah, I would say, too, the analogy of being a generalist versus a specialist. I think if you want to kind of drill down into this, Richard has some content online on his story, on how we got down into the family office. Find a specialty that you're passionate about, where there's not even a need in the market, but a perceived need in the market, and you could do it. See, for us, it's kind of easy. I only want to deal with people who feel they're paying too much in taxes. So that's a pretty good niche, right? So if someone thinks they're paying too much in taxes, we've got strategies for you.